Okay, so welcome to lecture 15, which I've called Anatomy of a Crisis. In that what I want to do is that I want to build on last week's lecture about the global financial crisis, the bricolage, the conjuncture, and I want to talk about the implications of the Minsky moment that we referred to last time out. There are three parts to the lecture. First part is to understand how the global financial crisis transitions from a bubble into a full-blown financial crisis and recession. I also want you to understand the concept of quantitative easing, in that quantitative easing was seen as being the solution to the problems caused by the global financial crisis, in that quantitative easing is a method or as a tool used by the central bank in order to stimulate growth in the economy by making more money, liquidity available to the banking system. But in order for us to be able to do both of those is that we do need to understand some of the important elements of government financing and government debt, in that a lot of the orthodox way of thinking about government debt is very much like theories of banks and credit theories relating to money is less than valuable at best. Okay, so I would want to take you through some of that. Now, the lecture itself is can be in places quite technical. So I'm just going to go all the way through the lecture. I'm not going to break it down into various sections, but just take some time out from the lecture, i.e. stop it, pause it, go away from it and come back and start again once you've got your head around the various concepts that we're talking about here. I think as a whole, there's a lot to take in, but if you break it down and you chunk it down, possibly even from slide to slide, that's a good way of doing it. So don't feel too concerned if you just need to say, hang on a minute, I need to go back and relook at that bit, and then do that, and then go take a break and then come back into it. Because I think that actually that's the best way of moving your way through the lecture. So without further ado, where we left it last time was mortgages and the subprime bubble. And the problem here is linked to the growth of the subprime market, i.e. subprime being the non-prime market, the subprime being the part of the mortgage market. Remembering is that the global financial crisis was founded upon mortgages and derivatives based upon mortgages, is that the increase in the subprime market, principally as a consequence of the demands of the banking sector for more mortgages, means that the repayments of those mortgages becomes more risky. Subprime basically is being issued to households with a FICO, which is a credit score below 620. In other words, is that mortgages are being issued to people and households that in normal circumstances would be considered to be a considerable risk that they would be defaulting on them. But they're not there are a lot of them, as it says there in the top of that bullet point, is that 20 to 25% of total mortgages in the US between 2004 and 2007 are being issued into the subprime market, i.e. the mortgage market, which is very risky. The bubble is fueled by investment banks as the securitizers, selling the loans on, who finance the subprime lending boom. Lehman, Royal Bank of Scotland and Bear Stearns are particularly aggressive, benefiting from their vertical integration. In other words, is that their retail banks are selling and originating mortgages, and then they are passing those on to the investment banks that are securitizing them and creating the collateralized debt obligations, the bricolage, which emerges from the conjuncture. And you get a huge growth in non-standard, non-prime loans, and types of those loans are just listed there. Quickly, ninja loans, no income, no job, no assets. ARMs, loans which have got initial teaser rates that jumped to a much higher rate after 2 to 3 years. Alt-A loans, where borrowers have got no documentation or less than full documentation, i.e. proof of earnings. And jumbo loans, a loan which is above industry standards. In other words, all of these loans come together in order to be able to boost house prices, remembering that when flows of money into a particular asset class drive up the asset price. It has to, because nothing new is being built. Once the house has been sold and it's resold, is that nothing new is produced as a consequence of it. And so flows of money into the housing market will, by definition, increase the prices of houses. And slightly incongruously, as I've given you an example there of an interest only of those jumbo loans where houses or the mortgage is being levied on 125% as an example of the actual price of the house, which means that these were popular because the house can be bought and it can be flipped, it can be developed and it can be flipped. So a lot of people are moving into the market in order to be able to make returns on their assets that are doing it. But this is an example where Minsky would class this as being Ponzi financing, in that people are borrowing money in order to pay back their debts on the sale of the property that they've just taken the money out to buy in the first place. And it's just a graphical representation of the growth in subprime mortgage securitization between 1995 and 2006. And what's noticeable here is that you get a slowdown in 2006 from 2005. Why is that? Well, possibly that might well be because of the fact that everybody who's wants a mortgage has now got one. Now, the part of the underlying logic between buying a house from a subprime perspective was that you could make money on it. Well, the growth in mortgages is based upon new entrants entering into the market, more money entering into the market. Once that slows down, inevitably the prices will start to slow, which will mean that the opportunity to be able to flip the property that one has bought and make a profit on it is declining. Less entrants are entering into the market, which means that the market itself is going to slow down, and inevitably you are going to get defaults. Q1 2007, the defaults rates start to rise, particularly as the teaser rates that have been taken out now reset to much higher levels. This leaves the house owner with options to try and service the debt, to try and very, very quickly sell the property at a loss, which would mean that that was likely to bring down house prices in more general terms, or to simply just default, to walk away. And once they default, then of course that the underlying mortgage fails, and then whenever that mortgage has been used in the CDO champagne tower will fault as well. And as a consequence of that is that all of the securitized financing starts to fail as well. So the securities, mortgage-backed securities, backed by subprime loans, widely held by financial firms, lost a lot of their value. And you get therefore the classic case of a deleveraging, the great unwind. In other words, you need to sell your CDOs because they're going down in value before they go down to the extent that you just lose too much money on them. So there's a race basically in order to sell the assets. Is that the price of the assets are going down, is that you need to sell them at a level which you get some money back in a declining market, which means that everybody is entering into the market at the same time to sell enormous amounts of CDOs, referred to as the great unwind. And this, as a consequence, means that financial institutions are booking losses on their securitized notes as the defaults rose. The mark-to-market value of the book assets falls sharply. And what that means is that there are two ways of valuing things. Is that, let's say as a house, is that I could get a mortgage broker or a estate agent to value my house, and they might say it's worth £500,000. but actually I might therefore, when I sell it, I might have to bring the price down in order to actually sell the thing, and it's really only worth £400,000. Well, the latter one is what's known as the mark-to-market valuation, as I say, as opposed to the paper valuation. It's the real valuation at sale. So the real valuation of all of these assets on the book fall, and this lowers the capital adequacy ratios. In other words, under banking regulation, is that banks are required to hold an amount of quality capital against their loan books. Well, if the value of their capital is declining, then their ratios are declining too. So the banks are therefore in a quandary as to how they can marry up their capital ratios. And simply put, is that a bank, rather like a business, has got assets and liabilities. If its assets are higher than its liabilities, then it is solvent. If the assets that it holds are declining in value, then it goes down, but its liabilities stay the same. And then once its assets are lower than its liabilities, the bank has to stop trading. So this is putting considerable pressure upon the banking sector. And this all leads to the credit crunch, because you get serious concerns about risk and solvency from people that you are lending, or other banks that you are lending money to. Now, banks rely upon loans from other banks in order to make up capital ratios. So as an example, if Barclays needs £30 million overnight in order to be able to have the right level of capital on its books, in order to meet its ratios, it might well borrow that money overnight from another bank. So it would go to RBS and it would ask them how much it would require, what the cost to borrow that money would be, which would be expressed in terms of the London interbank overnight rate. And if they were going to agree on that, that would be fine, and then the transaction would take place. But in order for that to happen, is that Barclays would need to put up collateral. So RBS would say, what collateral do you have? Barclays would say, well, we've got these mortgage-backed securities, these CDOs, and RBS at the time was saying, we're not accepting those as collateral. Do you have anything else? So in effect, the credit crunch refers to a period of time when the banks lost trust with each other and the quality of the capital that they were holding, to the extent that they stopped doing business with each other, and the financial system stopped circulating money, and it ground to a halt. Consequently, LIBOR rates, interest rates, increase because of the perceived level of risk. Banks are hoarding capital, stop lending to each other and also to other businesses. Just forget that next bullet point there. So I'll come on to that in the next slide. Governments, therefore, are forced to step in order to be able to provide markets and restore confidence. The way that the governments would do that is through issuing liquidity from central banks. So in the US, the Fed commits 11 trillion to resolve the financial system, and the UK government commits to 1.5 trillion in terms of a bailout. But in these instances, what happens is that public debt increases. Now, the relationship between the government, the Treasury, and the central bank is a complex one, and we'll talk about that in a minute. But what you do need to just appreciate at this particular point in time is that money is being made available by the central bank to the banks in the financial system. But because the central bank is part of public financing, is that increases the level of debt that the government has issued. So money that goes out to stabilize the financial system increases the size of public debt. And in the UK, is that public debt rose beyond 100% of its GDP for the first time in a period of time. And that's worth noting there as well, because I'll come back to that point later on as well. It is estimated that approximately $37 trillion has been used in order to stabilize the financial system from between 2008 and 2014, 37 trillion. The next statement there is that when 37 trillion probably pales into insignificance because Mario Draghi takes over the directorship of the European Central Bank and commits to do whatever it takes. In other words, the European Central Bank commits to spend or to make provisions available, whatever is required in order to stabilize and to refloat the economy. So let's move on now to try and understand this relationship between government financing, central banks, and government debts. Okay, and I referred you here to a reading in the reading list online by Ray, and it's his outline of modern money theory. Modern money theory is a new way of looking at public financing. It puts public financing at the center of its financial models. I don't see it as being a new way of thinking about it, but it is more of a focused way of thinking about government money and government financing. But it's also worth pointing out is that other non-MMT experts have corroborated the theories that are being written about within MMT, most notably Steve Keen, who has modeled an economy under MMT, under his Minsky program, to show that actually the claims of MMT are empirically correct. Right. So having said that, then what are we talking about here? First off, is that we need to be aware of is that money exists in the form of deposits. So you can forget coins and notes because that's only a small amount of the percentage of money that's actually in circulation. Money is zeros and ones held upon the electronic balance or electronic terminals of the various banks, just as in your account is just an entry into something equivalent to an Excel spreadsheet. Okay, it is not tangible in that way that we think of tangibilities for notes and coins. The bulk of money is just held in deposits. Governments interface with the private sector in a non-direct way, but they have to do it through the central bank and the central bank's reserves. Now, the central bank is a central player in this particular relationship. Governments have an account with the central bank. All of the banks have accounts also with the central banks. So the government moves money around from its account into the reserve accounts of the various private sector banks via the central bank. Okay. Similarly, if the government is to spend money, it will spend money into the economy via the central bank, and it will tell the central bank to increase the account of, it will tell the central bank to increase the reserves of the account of whomever they were spending it with. So let's say that the government wants to spend 100 million on PPE to firm X, and firm X has a bank account with Barclays, is that the government via the Treasury will instruct the central bank to increase the reserves of Barclays by 100 million, and then Barclays will increase the account of firm X by 100 million. Okay, so there is always this relationship that involves the central bank here. Now, reserves are an asset of the central bank, but they're liabilities of the private sector banks. Okay, that's accounting, just simple accounting. And you know what assets and liabilities are because of your studies in accounting as well. Now, conventional thinking regarding government financing is demonstrably, I've put incorrect there, misguided, I think probably is more to do with it. Because of the fact that money is not perceived as being important within economics, is that therefore banks rarely appear as being important agents within economics as well. It's assumed that, you know, a consumer buys goods direct from the supplier, but actually all transactions require a bank. So banks are an integral part of the economic system. And in the government system, they're more integral. But we are talking primarily here, of course, about central banks, and central banks are a special kind of animal. Now, one of the areas that is demonstrably misguided is the idea that governments borrow from the private sector to finance spending. In other words, government spending is financed out of taxation. This is not the case. If that were the case, is that if we were all a country and I was the government, I would not be able to spend money until you had provided me with enough taxation in order to be able to spend the money. But where would you get the money from in order to be actually to pay the taxation? So it's a kind of like a circular argument, but ultimately the logical conclusion is that the government spends the money first and then claims it back in taxation. Government spends money, okay, it creates money, it spends money into the economy and then claims it back in taxation, which is in effect destroying money. The money supply is the difference between spending and taxation. And that's an important thing to remember there. So when governments spend more than taxation, they're effectively increasing the money supply because it increases the size of deposits. Governments spend money in the processes that I've outlined before. Banks increase the accounts of the various recipients of the government spending, and the central bank increases the reserves. So government spends governments spend more than they tax. They're effectively increasing the money supply because it increases the size of deposits by exactly the same amount as the deficit, which increases the liabilities of the banks. In other words, their reserves. Now, there is a view that it is the reserves of the banks that drives their activities. Now, we've flipped that relationship, and that actually it's the deposits of the banks that drives their reserves. Okay, reserves come latterly. Now, that was actually outlined in a paper by Holmes, who was the director of the Federal Bank of St. Louis in 1969, which basically said that bank business activity is not driven by their reserves. And that's important to remember that. So the deficit creates money for the private sector. Okay. The opposite, therefore, when government taxes more than they spend, i.e. the government operates in a surplus, reduces the money supply. It starves the private sector. Because it's a balanced system, if we just take out the foreign element of it at the moment and just say that we've got an economy, the UK, and all of that money in it must balance out to zero wherever it sits within the public and the private sector. If the public sector is operating at a deficit, then the private sector operates at a surplus. If the opposite happens, then the government operates at a surplus, the private sector must be operating at a deficit. The private sector is in effect declining. And that means that it is optimal for the government to operate at a deficit, to spend more than it receives in taxation. Now, the size of the deficit is a political decision, but there is no financial or economic reason as to why a government cannot operate on a deficit. So, when a government operates on a deficit, it usually issues treasury bonds to the same amount as the deficit that it's operating on. So when spending is more than taxation, reserves increase in the central bank by exactly the same amount. Now this relates to treasury bonds. Just bear with me for a minute. The government spends, the accounts of the recipients go up, the central bank increases the size of the reserves. Reserves increase by exactly the same amount as government spending deficits. But the reserves attract no interest. So buying a bond, a government bond or a treasury bond, is an exchange of non-interest earning money, central bank reserves, for interest earning money, treasury bonds. So the government operates at a deficit, reserves go up, which means that Barclays, for want of another bank, is sitting on increased levels of reserves. What does it do with its reserves? Well, instead of it sitting there earning no money, it can exchange those reserves for treasury bonds and gain a fee, gain an interest. It can make money out of its increased reserves. So by exchanging non-fee earning money with fee earning money is that the bank itself makes a profit. And that's the primary reason why treasury bonds and issuances of treasury bonds are always oversubscribed. And of course, because they earn a fee, is that also increases the money supply as well. Not issuing a bond would mean that the government would just run an overdraft with the central bank, which is owned by the government anyway. Independent from, not all central banks are, the Fed isn't. The Fed is a private institution, but the majority of central banks are owned by the governments. So by not issuing the bonds is that the money supply would increase by spending minus taxation. Issuing the bonds means that you've got interest rates that go in there that increases the money supply. Bond sales primarily avoid the need for an overdraft, fundamentally because most countries legislate against their government being able to run an overdraft, although that has been relaxed recently because of COVID, where the need to the possibility of an overdraft has been reconsidered, and governments have run overdrafts as they've increased their levels of spending. They've not needed to be matched up by issuances of treasury bills. So let's just go through this slowly for a minute. The government increases spending, which increases the level of reserves. The banks use the increased reserves to buy the bonds off the government. Okay. So where's the actual deficit that's going on here? Where's the debt in effect? The profits of the central bank are remitted to the treasury. Let me just go back to that again. I'll do that again. Is that the government spends money on a deficit, reserves are increased. So the reserves are used, therefore, to buy deficits. To buy the bonds. So it is the deficit spending that finances the purchases of the bonds in the first place. As a consequence, the net of all of this is zero. The only differential that comes out of it is the interest payments that need to be paid to the institutions that are holding the bonds. But that has the positive impact of increasing the money supply. The stock of debt, therefore, is equivalent to the size of the money supply. And the last point on here says that the profits of the central bank are remitted to the treasury. And the reason that I've put that there is that should the central bank step into the market and buy bonds back off banks, then the central bank will receive the coupon payments, the interest rate payments that the banks were previously receiving. Well, they are profits. So the profits, therefore, would go back to the treasury, which means that the income that was being passed from government to banks now goes to the central bank and then back to the government. So in effect, everything has been netted out to zero. So that deals with the future burden. Because if the central bank buys the bonds, there is no future burden. The stock of debt is really just an accounting entry. Let's consider an empirical example. The deficits run up as a consequence of World War II. And you remember from the charts that I've shown you in the past, is that historically, that's the highest level of government spending that we've ever seen, probably prior to, well, I think it's just still above the levels that we've spent on COVID. That might soon change, of course, what were the awareness regarding various variants and so on and so forth. That might well change, but nevertheless is that government spending or government deficits have been higher than they have been currently. And the theory, therefore, that it should have been a burden to the future generations would have impacted directly upon the future generations or as a subsequent to World War II. Well, that's not the case, is it? Because the generation that occurred after the end of World War II was the baby boomer generation. And actually, it would appear that they've done quite well out of it. So taking Steve Keen's figures, the golden age, the period of the golden age on the left there, from 1950 to 1973, comparative to post-war periods and the post-golden age period and the post-global financial crisis period, shows unprecedented levels of growth and lower levels of unemployment. Inflation and the levels of deficit are also manageable. Debt levels, public and private, in the golden age start at 87.4% of GDP and decline to 40.4% of GDP. Private sector debt, however, on the other hand, grows from 55.8% to 94.3% by 1973. And it is subsequent to 1973 in the era which we have referred to as the financialized era that we have seen a commensurate growth in private sector debt. Public sector debt is less of a problem than private sector debt for the reasons that we've just outlined. And yet, it is always the fiscal hawks that would talk about the problems that relate to public sector debt and so on and so forth. These are not economic or financial arguments. They are political arguments driven by various political parties' own political ideologies. To illustrate the view, and what you can see from this is that government spending or debt as percentage of GDP leading up to the financial crisis is stable, declining or increasing dependent upon the policies of the various governments that are in place. Government debt increases after the global financial crisis. And this should do away with the view or the theory that it was government debt that increased or caused, I should say, caused the global financial crisis. This is a nonsense. The causes of the financial crisis are those that we talked about in earlier lectures. But why does government spending debt increase so dramatically? As you can see the curves going up very steeply as a consequence of the financial crisis. Well, principally, it's two reasons. One is that as an economy moves into recession, the increase in transfer payments goes up, i.e. welfare payments goes up dramatically, which increases government spending. Second is that because of the state of the financial system, is that the governments stepped in to provide money to stabilize the banking system, which would have had an impact upon the finances of the government. So both transfer payments to the population and payments to the banking system are after the collapse of Lehman Brothers and the global financial crisis. In no way, shape or form is government spending a contributor to global financial crisis. It is not causal, it is as a consequence of the global financial crisis. So I think it's probably opportunistic for us to remind ourselves about monetary policy at this point. Monetary policy is the central bank tool to increase or decrease interest rates to control inflation. If the economy overheats and inflation goes up, then the view is that by increasing interest rates, that will cool down the economy by slowing down activity, which will dissipate inflation. And the converse is true, as if the economy is deflating. If the economy is static or is in recession or is underheated in any way, shape or form, by reducing the interest rates, that can stimulate economic activity, because interest rates have an impact on making money cheap. And if money is cheap, people will borrow it and spend it, and that will stimulate the economy. There is a target inflation rate, which most central banks are mandated to try and achieve, which is 2%. And that's believed to be the ideal inflation rate for an equilibrium economy, notwithstanding the limitations in our concepts or our empirical observations that pertain to markets and equilibrium and so on and so forth. But it's interesting to note the domination of the concept of equilibrium markets and equilibrium economies within political and government and central bank circles. But 2% is believed to correspond to equilibrium rate for the economy. So you manage the inflation rate to 2%, ergo the economy is in equilibrium. Now, if you can be mindful of it, go back and have a look at any country and see what its successes have been like over the last 40 years at maintaining a 2% inflation rate. Central banks are independent to set the desired interest rate. It's purely and simply an economic function or financial function. Some central banks are also mandated to achieve an optimal employment rate. So the Fed, as an example, is targeted to hit 6.5% unemployment rate. Interestingly, though, inflation and unemployment are believed to be in a reverse relationship. So low unemployment causes inflation. So if you have inflation above 2%, then one of the ways in which one might resolve that is by creating unemployment, which brings the inflation rate down. So central banks, therefore, might be mandated in order to be able to hit their targets by taking away people's livelihoods in order to be able to stabilize the financial economy through the price economy through inflation, which is an interesting concept at best. Central banks are the lenders of last resort and use their monetary policy in order to be able to achieve desirable economic growth. Lender of last resort means that they provide liquidity to the banks in distress in times of financial collapse. And that's exactly what happened in 2007, 2008, is that the central bank steps in and provides liquidity and operates as the lender of last resort in order to shore up the banking system of the relevant economy. After the 2007 crisis, all major central banks acted first as lenders of last resort, but then secondly, as providers of monetary stimulus, referred to as open market operations, in order to be able to achieve economic recovery. And I think that's the most important point here, is that the activities of central banks are geared up towards achieving economic recovery and desirable economic growth. Monetary policy, as part 2 of that, of their toolkit, involved what's known as large-scale asset purchases, which became known as quantitative easing, buying both government and private company bonds, as well as other assets, but predominantly government and private company bonds. Okay. Whoops, wrong way. So there's the first part. There's the first part of the toolkit, is that we reduce down interest rates, and all the central banks dramatically reduce their interest rates down to historical lows. The current conjuncture shows that we are operating in unprecedented territory as far as central bank interest rates are, historical lows. And then secondly, central banks engage in quantitative easing. And this is a graph of the balance sheet of the Bank of England, where it's the balance sheet has been balanced out to, or based out to, rebased to 100 in 2008. In 2008, you see that initial spike, then a little flutter as payments are made to the banking system and welfare payments kick in. The bank then there's a lull before the storm, and then quantitative easing kicks in late 2008, early 2009, and has carried on pretty much consistently since then, and has been dramatically increased as a consequence of COVID, to the extent that quantitative easing could be said to comprise the new normal of central bank policies. But I think that what's interesting, if we just take a little moment out at the moment, is that a lot of emphasis is put upon the capacity of the central banks in order to be able to manage the economy. And yet the tools that it has to do that is the rising and the increasing and decreasing of base rate, and its own capacity to be able to intervene in the market to buy up assets. That's it. That's what it has. But nevertheless, is that there is a huge expectation that central banks have got the capacity in order to be able to perform, frankly, economic miracles. And this just shows you the size of the balance sheets of the major central banks. Now, why the balance sheet? Well, because if the central bank is operating in the market to buy up assets, then its balance sheet will increase. So the size of its balance sheet is equivalent to the amount of money that has been issued in terms of quantitative easing. Okay. And it's dramatic. And this one stops in, I think, 2016. And if we were to add on the COVID graph as well, then there's another hockey stick that goes up again that's on top of it. Now, what's interesting is that the fiscal hawks said that government spending is out of control and it needed to be controlled, that government spending needed to be reduced. Now, from what you've already heard, this is frankly, a ridiculous concept. Keynes was well aware of the impact of that and warned against doing exactly that back in the 1930s. But the governments of the day, not just in the UK, but across the various political spectrums, convinced the population that government accounts and government financing was like a household, in that it needed to live within its own means. The Conservative Party in the UK convinced the population that the previous government, the Labour government, had been profligate with government money. It didn't save money whilst the economy was in a good in good shape. And as a consequence of that is that when the global finance crisis occurred, is that it didn't have the capacity to be able to weather the storm. Governments should manage within their own means. In other words, they should manage either a balanced budget or a fiscal surplus. And we've seen what the problems of that is. Now, the UK voluntarily entered into austerity measures, i.e. it started to reduce public spending. Other economies throughout Europe had austerity measures forced upon them through the European Central Bank, because some economies of Europe, Greece, Spain, Portugal in particular, Italy to a lesser extent, were struggling with the size of their debt burdens, and the European Central Bank provided financing to the over-indebted nations, but insisted upon austerity measures taking part as well. But this analysis from the New Economic Forum, done in 2016, shows that where there has been a degree of fiscal tightening, which is the bottom axis, as a potential of as a percentage of potential GDP. In other words, the more austerity is that actually has decreased the growth within the economy itself. As you can see, that the bottom one there is Greece, and then below that is Portugal, Cyprus, and Spain. All of those are economies that were forced to undertake austerity measures. In other words, austerity closes off money, reduces the money supply, which reduces financial activity, which reduces economic activity. More simply put, is that GDP, which is expressed as the identity of GDP, national income, equals consumption plus government spending plus investment plus the foreign effect, just demonstrates that if you reduce the government spending element of it, then GDP declines by exactly the same amount that you reduce government spending. It's mathematics. There's no argument about it. Although there is an argument, because the argument suggests that if you reduce government spending, then you reduce the future tax burden of the people of that country, which means that people think that they can spend money now because their tax burden will go down in the future. I kid you not. That is the logic behind austerity measures, and it is puerile beyond belief. Austerity measures, combined with a global financial crisis, set economies backwards, not forwards. The government is not like a household. It does not need to live within its own means. It is the monopoly supplier of its own currency, for goodness sake. It can make policy decisions and back them up with financing as it sees fit. So austerity, particularly in the UK, was politically motivated, not economically motivated. So quantitative easing then, what is it? And you can go and look at the Fawley and Neely paper, which is on Reading Lists Online. It goes into an awful lot of detail, but I know that students get quite excited about this as a study, and that's fine. If you want to read it, it's there for you to go away and read it. You don't need to know that, okay? So I'll go through it and outline it, and just outline what I think that you really ought to be aware of. So quantitative easing is often referred to as money printing. And of course, it's not printing money, is it? It's providing liquidity to the markets. The term's credited to Richard Werner, who used the phrase after observing the Japanese financial crisis in the early 1990s, where Werner was actually working at the time, which is beautifully described and explained in his book called The Princes of Yen, which is actually on Reading Lists Online. It's a fabulous read if you're interested in government financing. There are different methods of quantitative easing, okay? Lowering interest rates is a method of providing additional money to the economy. Increasing reserves will do it. But buying company assets, bonds, bad debt, commercial paper, TARP, as it's known as Troubled Asset Relief Program, and also buying government bonds. And there is a mix between all of those that various central banks did in order to be able to engage in quantitative easing. Now, the problem with quantitative easing is that, does it actually ease credit conditions? Does it make money that's available to the economy in order to be able to use for productive purposes? And that is a question that the banking sector would suggest is a positive, is that quantitative easing has been very successful in providing additional liquidity to the banking system. And we're back. So let's have a look at some of the evidence as to whether or not quantitative easing increased credit easing, or eased conditions of credit, which meant that productive capacity or finance was provided for productive growth. As I said earlier on, it's the US that's been the most aggressive in QE since the COVID-19 crisis, well, almost doubling its balance sheet. And this is just an illustration of the amount of money that's been pumped into the American financial system. The Fed's balance sheet is now equivalent to $7.2 trillion. And what would that be? About $3 trillion additional since March 2020. I always get confused by American dates. For some particular reason, they decide to put the month first, which is irritating. But QE has been dramatic. However, when you analyze bank balance sheets up to the period of 2011, during the first part of quantitative easing as a consequence of the global financial crisis, remembering, of course, is that reserves, assets have been purchased, open market operations have been going on in order to be able to provide liquidity to the banking system, because the banking system, if its reserves go up, will lend money into the economy. So this analysis looks at the state of bank balance sheets in the US during this period of quantitative easing and concludes that QE failed to increase credit to the real economy. Shareholder-driven banks do not take long-term credit risks in low-growth economies. Broader aggregates did not increase because banks voluntarily held the increased monetary base as bank reserves, safe liquid assets in high demand during periods of economic uncertainty. And you can see that from the graph below, in that you've got real estate loans, which are the blue line at the top, which declines. You've got corporate loans, which is the green line, which is flat. And then you've got consumer loans, which is the red line, which is flat. Pretty boring graph, really, isn't it? The only thing that does grow is the purple line, which is the amount of cash that the banks are holding. So the impact of QE was really to secure the financial system almost exclusively. The banks didn't lend the money, they held on to the money. Because as the text at the top of this slide says, is that why would a bank lend money into a period of economic uncertainty where growth is very, very slow, if there's any growth at all, particularly when it can hold on to its reserves and it can trade its reserves for bonds, which make a profit. And if you, I mean, this is not causal, you can't say this is causal, but what you could do is you could have a look at the two curves, which is the balance size of the balance sheet versus the S&P 500. So the Fed balance sheet's the blue line, the S&P 500 is the red line. And they're rather close, aren't they? And you can't say it's causal because, you know, there's just there's a correspondence. But if QE was designed to produce productive capacity, then this correspondence is worth looking at and going into it in terms of a little bit more detail, isn't it? And it's likely that QE failed to increase investment by privatized firms because the firms which are financialized used additional monies or availability of cheap money in order to be able to maximize their share price. And as a consequence, do not invest or would not invest long-term in a stagnant economy. So just as the banks are not likely to invest in a stagnant economy, why would firms? But firms are competing in the stock market on share price. In this financialized world, is that share price less than productive capacity is what most chief executives are being judged by. And therefore, can we see any activity that's ongoing that would support this particular view? Well, we can. In a study by Ismail Ertuk, 2016, is that Ismail looked at the issuances of corporate bonds and share buybacks, and they correspond with each other very closely. If you look at the first column, US share buybacks, reach a peak in 2007 and decline down to 2009 and then pick up again, back to the point where they were back in 2007, approximately $500 billion a year. But how's it being financed? Bearing in mind is that money is cheap, is that firms are financing their share repurchases by issuing corporate bonds. And if you go to the right-hand side of the chart, you can see that there's a commensurate increase in bonds. The low interest rates under QE leads not to investments, but to share buybacks. Financialized firms issue low-cost bonds to buy back their shares, which artificially increases their share prices and allows managers to have high bonuses. And just as the CARE Act restrictions have been lifted in America to say that firms cannot use American Fed money to buy back their own shares, just as that has been lifted, we've seen figures in recent lectures to suggest that share buybacks, excuse me, have now reached a historical peak. Furthermore, is that you get a portfolio reallocation. In other words, investors switch money from low yield bonds into the stock market because that's where you're going to get higher gains. But it also encourages mergers and acquisitions. At the time of a merger and acquisition is that the impact upon share price is normally very positive. So if a firm announces it is going to acquire another firm, is that usually both firms' share prices go up. And this is because markets like mergers and acquisitions, because it is an indication that you're going to get economic efficiencies. Stock markets reward high premium M&As, but effectively they punish long-term capital investment. It's quicker to get economic growth through buying another company than it is to actually produce more goods and services or innovate within goods and services in order to generate something that's worth buying. And just as we've seen in previous charts, is that mergers and acquisitions peaked in 2007, declined, but then has grown rapidly since then. And this is despite the generally held view that M&As, only 15% of mergers and acquisitions create economic value. The majority of them destroy it. Well, we've met the Bank of International Settlements before, and this is a statement in the report from 2014 on the impact of central bank policies. And the BIS state, the risk is that over time monetary policy loses traction while its side effects proliferate. These side effects are well known. Policy may help postpone balance sheet adjustments by encouraging the evergreening of bad debts. For instance, it may actually damage the profitability and financial strengths of institutions by compressing interest margins. It may favour the wrong forms of risk-taking and can generate unwelcome spillovers to other economies, particularly when financial cycles are out of sync. Tellingly, growth has disappointed even as financial markets have roared. The transmission chain seems to be badly impaired. The failure to boost investment despite extremely accommodative financial conditions is a case in point. Unconventional central bank policies have created malign distributive and allocative results in a financialized economy. And we're starting to question, therefore, central bank policies. But within that statement by the BIS is that they make the claim that the transmission chain seems to be badly impaired. So what's the transmission chain? So this is the transmission chain, which is the way in which the central bank monetary policy, QE, is supposed to impact the wider economy, okay? And there are three channels. Is that if the Bank of England buys large numbers of assets, it increases the expectations of the economy, which actually increases spending and income, and inflation settles out at 2% as it moves towards equilibrium. Or the Bank of England, through buying more asset prices, by buying assets, increases the asset prices, which increases total wealth, reduces the cost of borrowing, spending and income goes up, and inflation settles out at 2%. And then the third element is that the asset purchases increase the money supply, which increases bank lending, which increases spending and income, and inflation settles out as the economy gravitates towards 2%. Now, this is what the view is here, is that the transmission chain seems to be badly impaired. Well, the transmission chain doesn't seem to be badly impaired. It seems to be not correct in the way that it is being set out here. In that the view is here is that the activities of the central bank drive the economy. Reserves drive bank activity. And this is incorrect. Is that economic activity drives the level of reserves. Is that, to give you an example, let's say the House of Saud turn up at our bank and they want to borrow 30 billion from us. We know they're good for it, so that's fine, but we haven't got the reserves to be able to lend them 30 billion. So what do? Do we say, well, I'm sorry, we can't do that money because we can't do that business? Or do we do the business and then we say to the central bank, well, you tell our shareholders why we can't do it, or you make the money, you make the reserves available to us. So activity drives the reserves. Reserves don't drive activity. The transmission chain is not badly impaired. The transmission chain is conceptually inaccurate. That's just a point here to add at the end of this, is to say that unconventional monetary policies have taken a historical turn. And this just shows the balance sheets of central banks across the globe. And as you get to that peak at the right-hand side of the chart, so the conjuncture shifts, doesn't it? Not only does interest rates at an all-time low, but also is that the risks of the balance sheet or the activities of governments and of the central banks are dramatic as a consequence of COVID. But you know, that I do have a view is that what would the alternative have been? But the conjuncture has changed dramatically. And what we must take into account, and this is an article from December 2020 in the Financial Times, is that central banks' QE policies over COVID have made debt cheap, and it's increased borrowing by the corporate sector. And again, do we see examples of Ponzi financing? I think I've shared with you some figures in the past which suggest that firms are borrowing money by selling bonds, but the bonds are non-investable grade, of which they are paying the returns on those bonds back on their business returns. And this looks very much like activities of Ponzi financing to me, in that they're borrowing money on the long term, but have only got short-term capacity to pay it all back. So you've got an increase in the amount of firms that are unable to cover their debt servicing costs from their current profits. And in fact, they're zombies. And the chart below shows that you've got an increasing share of zombie firms. 15% of firms are considered to be suffering from debt servicing costs. And the blue line shows the probability of them remaining zombie companies are up to 90%, i.e. that they're zombies now, they're trapped in a debt cycle, and they are likely to remain zombies. Now, the question that I've got about this is that where's the market? The market is supposed to clear these out, these dead firms. Creative destruction and all of that. Stock markets has been efficient ways of allocating capital to high performing firms. Well, this is not the case, is it? Finance is protecting poorly performing firms economically. Now, let me just say, there might be a reason why we should protect these firms, because they're employers, they're paying people an income and so on and so forth. But if that's the case, then they shouldn't really be, because of the fact that they're effectively zombies, they shouldn't be paying dividends, they shouldn't be buying back their own shares and stocks and so on and so forth, which has negative impacts upon the firm in and of itself. So there's arguments, pros and cons for all of this. But the idea that the market and that finance allocates capital efficiently really needs to be very, very strongly questioned, because the evidence would suggest that's not the case at all. Because fundamentally is that capital markets have become disconnected from the productive economy. Capital markets have become less of a financing mechanism for the productive economy, but more of a mechanism for speculative financial returns. It's the playground of the rentier, and not the habitus of the income earning majority. And then we can add in aspects of climate to this. Central banks have started to transition to a carbon neutral economy as a potential cause for financial instability. This is a risk, financial instability. In other words, we need to make sure that the cost of capital is maintained. And that Mark Carney has apparently a pool of financing available to the tune of somewhere in the region. It's astronomical. It's about 130 trillion in terms of promises for investments into climate change. But climate change investments, but only if it makes a return. So we're asking the models, or we're asking the globe to be behest to the financial models of the financiers. And what the bit of text that says there underneath it is, if the financial community acts on these recommendations, we'll be two steps closer to ensuring an orderly transition to a low carbon economy. We recognize that the challenges we face are unprecedented, urgent, and analytically difficult. This is text from the actual article, by the way. The stakes are undoubtedly high, but the commitment of all actors in the financial system to act on these recommendations will help avoid a climate-driven Minsky moment, i.e. loss of capital is what they're terming. The term that we're using to refer to a sudden collapse in asset prices. Now, it's being used incorrectly. It's not a Minsky moment in the way that Minsky would have understood it. But what it's suggesting is that capital can be used and is available for climate change, but only if it makes a return. And to my mind, is that the form of financing that is best equipped in order to be able to deal with climate change is not markets, but is actually the government sector that we've talked about earlier on today. As the government sector can fail spectacularly, but it doesn't go away. The government sector financed the development of the internet. The government sector put a man on the moon. The private sector weren't going to do that. The government sector in the UK financed Concorde, which was an unmitigated economic disaster, but a technological advance. So the government sector can fail spectacularly, but it can also succeed spectacularly too. And it just strikes me that if we are to rely upon the markets in order to finance climate change technologies, is that we could be waiting a very long time.